Welcome back. There is risk off across the global markets. So if you pull up the Asian market screen, Hang Seng is down close to about 4.5%. The rest of Asia is reeling with cuts of about 2 to 3%. European futures currently with the CAC futures down more than 4%. And watch out for the Dow futures. They were shut on Friday on account of the Independence Day holiday. The Dow futures too is pointing to a negative start, a kind of really cut of around 8.5%. So all this is because of Greeks' resounding no vote in the referendum. How will the global equities be impacted going forward, and what are the other key triggers to watch? Hans Goetti now joins us. Hi Hans, good morning. Thanks for joining in. Do you expect a protracted period of risk off for equities?
Well, what we have now is clearly a risk-off trade, of course, with the usual suspects benefiting, the US dollar, the yen, which in turn translates into lower Japanese equities. So you have a risk-off trade right now, because what the markets do not like under any circumstances is uncertainty, and we got plenty of it right now.
Okay, let's pull out the first futures rate that we're getting now on the European markets. The CAC futures are down 4.5%. That's the first rate that we have for this morning. Even the DAX futures are actually showing a downtick, but the CAC futures is something that I think we can show right now, and that's actually trading a bit negative. In fact, quite a bit down, about 4% or so. So Hans, last time we had something like this, we saw the way European markets stumbled, but the Asian markets moved on, India included. Would you expect something similar over the next 3 or 4 days, or do you think this time it could be a bit different?
It's probably going to be similar, but of course you have to take into account sentiment. Again, if you have risk-off trade, it affects every market, emerging markets, developed markets, and so on, and currencies, of course, first and foremost. So you have probably about the next 48 hours quite a bit of volatility until we see what the next steps will be. Looks like the Greeks want to go back to the negotiating table. The finance minister Varoufakis resigned. He was a very polarizing figure, and maybe that's the first sign that Greece might be willing to compromise a little bit. I think on the European side, there's a lot of interest in keeping the Eurozone together. I mean, we have basically a political construct, which it was from day one, and so far the political will to keep the Eurozone together has been there and has been very strong, and we still expect some kind of deal to be reached in the next few weeks. But of course, in the long run, the solution for Greece will have to involve some kind of debt forgiveness, which at the moment is certainly not being discussed. It's not on the table, but maybe something that can be discussed in the next few months.
So Brexit is not currently your base case scenario?
It's not a base case scenario. Of course, it's a possibility. We attach about 40% to a Brexit, which is quite high, but a no vote that we have seen does not necessarily mean we have Brexit. The probability may have gone up a little bit, but what we also have to bear in mind is that the risk of contagion to the rest of the periphery, of the European periphery, is not nearly as severe as it was a few years ago. You can see this in the yield spreads between peripheral Europe and core Europe. They maybe increased by 20-30 basis points, but not by 300 basis points as we have seen a few years ago.
Hans, we had our guest editor telling us yesterday that a Brexit may actually strengthen the euro because the weak link would be out. Would you share that view?
I cannot rule it out. I mean, we have maximum uncertainty now, and the euro is around 110 and not going near par to the US dollar. We also think that if you look at it from the other side of the equation, from the viewpoint of the Fed, I cannot imagine that they want a much stronger dollar, because that creates headwinds for the US economy as well. So it may actually filter into the decision by the Fed when to raise interest rates, and if you have turmoil in Europe, there's a good chance that an interest rate hike may come later rather than sooner, which will put some downward pressure on the dollar. Of course, conversely would strengthen the euro a little bit. But you can make the argument that the euro without Greece could be stronger. But again, there's so much volatility in between and so much uncertainty, it's hard to quantify this at this point.
Hans, you indicated that a deal is likely in the next few days. Will any deal be cheered by the equity markets, irrespective whether it's softer or harsher in terms of austerity for reforms or for aid?
Well, again, you don't have a final solution here. You have to imagine what the position that Greece is in right now. You have the banks closed. You have obviously the ECB, can sort of play God, and they cut the liquidity assistance to Greek banks. That's something under consideration. There are so many ways this thing can play out, and don't forget that on the 20th of July, Greece owes the ECB 3.5 billion euros, which they most certainly will default on, and after that, it's going to be very difficult for the ECB to maintain the liquidity assistance to the banks. So honestly, once Greece runs out of cash, there's a lot of things that can play out.
Okay, let's talk about something closer home than Hans. China, that's been a fascinating story. This morning, of course, we had the index up 8% and is now flatlining. Do you think there's a bit of a desperation from Chinese government? And what's your own call on the Chinese equity market now?
Well, in retrospect, you always see when you had a bubble, and this clearly has the same shape as the Nasdaq in 2000. In fact, even the extent of the drop is very similar, the initial drop. Now, obviously, the Chinese government would like to put a floor underneath, and in fact, this morning the market was up between 7 and 8% based on strength in a few very big blue chip stocks, and obviously there was some intervention there to prop them up. But at the moment, you have very negative sentiment. I think the 80% of the A-share market in Shanghai is dominated by retail investors, which makes it extremely volatile. You also have still very high margin debt, and this is a mix which is very difficult to put the floor underneath. Even if you throw the kitchen sink at it, which the Chinese government has done, I'm not sure what they can do more from here. But margin debt will have to come down, and this whole thing will have to play out. So it's possible that we may see a stabilization in the next few days, but maybe with a bounce and a retest. That's usually how bubbles play out, but it's impossible to see exactly which level it is.
All right, Hans, we'll leave it at that. Thanks so much for joining in. There was a Citi report which